Hi, welcome to Financial Accounting Basics videos. In this video, we will discuss about bank reconciliation process. Before we get into detailed discussion on bank reconciliation, let's understand what is a bank book and passbook and why do we do this reconciliation. Bank book, as we already know, it is maintained at business to record all bank transactions. Bank transactions means whenever bank whenever we issue checks to the suppliers or we receive checks from a customer or we make direct payments or when customer directly deposits amount into a bank or bank deducts money as a bank charges directly, like all the transactions which are related to bank will be recorded in bank book, which you have seen already in a earlier discussions, bank account and cash account. Okay, at the same time, let's see what is a passbook or what is a bank statement. Whenever bank clears checks on behalf of his customer, they record into books of the account. Suppose we have company called X Limited. If they issue 5,000 rupees check to its customer ABC Limited, we in a X books they record it rupees 5,000 is paid to customer. So it reduces the bank account balance in bank book. Same way, bank also, say ICICI Bank or SBI Bank, they will be having X account in ICICI, in SBI, SBI or ICICI Bank account. So in X account, what they do, there will be some opening balance which they have to make a payment to him, OB, but out of that 5,000 they are paying to ABC, so they record paid 5,000. So this will reduce balance in passbook also. So whenever balance reduces in our bank account book, bank book, same way the bank also reduces that balance against us. If any bank charges, any charges is charged by a bank, they debit charging 500 rupees as a bank charges, then same thing we need to record in our bank book as bank charges. Always the bank book and the passbook should get matched. So here instead of passbook we also have a bank statement sometimes. See, in the electronic era people will not give passbooks nowadays. We can download a statement on a net, just go give a date from date and to date and download the bank statements. So either way, whether it is a bank statement or a passbook, this contains all our transactions within that specified bank. And always the bank statement and my bank book should match. If it is not matching, we should find out what is the reasons for not matching. Correct? So this process is called as bank reconciliation. The process of identifying the reasons for differences in bank book and passbook or bank statement is called bank reconciliation process. Let's see how do we do it, bank reconciliation process. Before we get into the bank reconciliation process, let's see how the transaction happens. The receipts transaction which are related to bank, payment transactions which are related to bank. Receipts transactions. There are three types of receipt transactions which can occur in a bank. The first one is we receive a check from customer, we make some sales, business makes some sales, then against that sale, business receives check from its customer. Then what business does? They record in a bank book. They record a transaction. They received this amount. in the form of check from the customer, and then they deposit check into a bank. They collect all the checks once in a day or twice in a week. They go to a bank and deposit the check into a bank. Then bank will send it for clearing. Bank will collect all these checks. They send it to like one customer, they will be receiving it from all other customers. They club all the checks and they go to a clearing house and they clears the check. Once the check is cleared, the amount will be credited to bank account. And once the amount is credited, then we can print the passbook and see the balance. This is with respect to check. The process starts receiving check from a customer, depositing, recording that into books of account, depositing it, and then clearing of check, crediting the amount in a bank account or in a bank statement, then printing the passbook. This is the transaction for check. The same way, the second way of doing the business is sometimes we will ask customer, or a business will ask customer for directly depositing amount into a bank. This is called as direct deposits. So customer, instead of going issuing a check, what they do is they do a EFT transfer, fund transfers. In that case, the balance will directly transfer to customer's account in a bank. So remember, this information first will be available in bank, and banker will update this into a passbook, and the passbook will be prepared. Remember, there will not be any transaction in a books of account in a X company because the amount is directly deposited into a bank. Once the passbook they receive, they can record these transactions manually, or they can ask customer for some remittance advice or some other details to record the transactions. Remember, in the first case, check is received and recorded first in the books of account and then deposited to a bank and accounted in bank account. In the second case, amount is first deposited into a bank by customer, and then business gets information and they record it. Now you understood why the reasons for differences in cash book. There is a timing difference when check is recorded in our books and when amount is credited by bank. Because of the clearing dates and all these things, there is a difference. Here also, it is early deposited in a bank account, but it is recorded in a books of account once we receive a statement. Like this, these are the few reasons why we get a difference in bank statement. The next one, some cases, banks directly credit some interest on a bank deposits, or bank directly deducts some interest on their charges, or interest on loans given, ECS, electronic clearing. But in all these cases, bank account will be updated based on passbook. Okay, so the directly deposit bank will directly debit our account, and then a passbook will be updated. It will know records will be available in the books of accounts. So based on the bank account or a statement, our books of accounts will be updated. So these are the 3 or 4 kinds of receipts which we are talking here. One is receiving in the form of check. The other one is a direct deposit from customer. The third one is bank directly crediting some interests. Same way, if we get into a payments discussion, payments also, first business will prepare a check and then they record the transactions in the books of account, issues the check to a supplier, supplier receives the check and they record into their books and then deposit into a bank. Once the bank clears it, this will be accounted in a bank book and passbook can be printed. So there is a time gap. So when we prepare a check, it is issued to a supplier, supplier deposits into a bank and bank clears it. After this, the passbook will get updated. Till that time, there will be a difference between bank book in the business and passbook or a bank statement. The second way, there is some chances that where we will be bank will be directly deduct some charges like check clearing charges or interest, etc. In this case, once the bank deducts, the passbook will get updated and they will not be recorded in our books of account. That will be recorded based on passbook or bank statement. Now you understood, right? There is a time gap between when we record in our bank book and when bank records the transaction. The reasons for difference is the time gap between the time when we issue a check and it is deposited by supplier to a bank, or some cases bank directly charges, or there may be some errors. All these things causes differences between bank book and bank statement or passbook. Let's see bank reconciliation statement format. First, we have to take one balance, either bank balance or cash balance, bank book balance or passbook balance. We are taking bank book balance. Though we call it as a cash book, it is as same as bank book. So we take a balance, then we add check issued but not presented, because when we issue a check, this reduces our balance, but this particular balance is not recorded in bank because we have issued a check but it is not presented. And there are some transactions which are directly credited by bank but not recorded. All these things we are adding it here. So we get a revised balance of a cash book. Again, from this amount we are deducting check deposited but not credited by bank, and then bank charges not recorded in a cash book. If I deduct these two things, we get this amount, and then we get this is a balance as per passbook or a statement. The rules here is, if you are starting a reconciliation process with a cash book, you can start from passbook or you can start from a cash book or a bank book. In this given template, I am starting with cash book. Take a cash book balance and then add check issued but not presented, transactions credited by bank but not recorded. Add these things and then less or deduct check deposited but not credited, and then bank charges not recorded in the cash book. So once you add and deduct these transaction types, finally we get balance as per statement. So this is the process for bank reconciliation statement. So let's see summarization of reasons for the differences. What are the reasons for the difference? The first and foremost reason is error. Error may happen in our internal cash book or a bank book, or in a bank statement or passbook. Correct? Even there may be a recording error by accountant in the cash book, or there will be a recording error in bank statement. The second reason for difference is time gap. The first one is error. The second reason is time gap. We know there are two types of transactions we record. One is a receipt transaction, another one is a payment transaction. The time gap reasons is check received for, in case of receipts, check received but not cleared. So we have received check but it has not we have not gone and deposited into a bank. And this next one is direct deposit by customer in a bank, interest credited by a bank, or some check dishonored, we don't have information, All these things will be causing time gap for receipts. At the same time, for payments, check issued but not cleared, direct deduct from the bank towards charges or interest. So these are the reasons why bank book will not match to bank statement. Reconciliation process starts with either bank balance as per passbook or bank balance as per cash book. As I told earlier, reconciliation process we can start with either bank balance taking from a passbook or bank balance as per cash book. For example, or at the template which I show earlier, we were starting with cash book and we are deriving what is the bank balance. There are two options for reconciliation. One is reconcile without adjusting cash book balances, and the second one is reconcile by adjusting the cash book balances. What is the difference in these two cases? In the second case, what we are doing is we all record all the direct debit or direct credit in the bank account. Whatever there is a direct debits and credits are there which are not recorded in our books of account, we will record first and then we do a reconciliation. That's the first, that is the second option. In the first option, we take bank statement as it is and we will take cash bank book balance as it is and we will reconcile. No adjustments will be done. But in the second case, we will record all the transactions which have directly accounted in bank passbook, and if there is any rectification entries needed, we will record those rectification and then do a reconciliation. In every business, the second option will be used for reconciliation. First, they will. So, I'm repeating here, in all the businesses, they follow second option for reconciliation, wherein they first pass all the adjustment entries and all the direct accounted entries, direct debit entries, and then they do a reconciliation. Okay. There is another point of discussion during a reconciliation: balances, favorable balances and unfavorable balances. What it is? Normally, we know that bank account will show debit balance because it is an asset. Correct? So bank account, we will be having extra money, then only we will be keep on making the payments. But there are some cases when we have a current account, CA, current account. In case of current account, banks will allow company to withdraw more than the balance amount. In a company's account, if 10,000 rupees is there as a balance, there will be a facility called overdraft. Using overdraft, company can go beyond 10,000 and the OD limit, assume if it is 5,000, the company can draw 15,000 rupees because 10,000 is actual balance and OD limit is 5,000. So 15,000, right? So in this case, the balance will be called as unfavorable balance. Means favorable balance is a positive balance in a cash book, unfavorable balance is a negative balance in a cash book. The negative balance appears in a cash book because we have OD facilities. Remember, in case of our bank book, we say that, or a cash book, we say that favorable balance means if there is a debit balance in a bank book, then it is called favorable balance. If there is a credit balance, then we call it as unfavorable balance. At the same time, in a passbook, we call it, if there is a debit balance, then we call it as unfavorable balance, and if there is a credit balance, we call it as favorable balance. Let's see templates based on various balances. And the first one here, now what we have, bank reconciliation statement template for cash book balance. We are starting reconciliation from cash book, and where cash book is showing favorable balance. So bank balance as per cash book, we have favorable balance, means we have a debit balance. We are adding check issued but not presented, transactions credited by bank but not recorded. We get a balance now, revised balance. Again, out of that, we are reducing check deposited but not credited by bank, and then bank charges not recorded in the cash book. So when we sum these two, and we get a number here. Deduct this from the above value, so we get bank statement, bank balance as per bank statement. See the example here now. We have an example for bank statement starting with cash book and then favorable balance. From the following particulars of Mr. Shankar, prepare bank reconciliation statement as on 30th April 2016. Bank balance as per cash book is 25,000. Bank balance as per passbook is 36,500. There is a difference of 11,500 here. So we need to find out why there is this difference. What are the transactions which are causing the difference? Here are other transactions. Check issued to supplier but not presented, 20,000. Check deposited to bank but not cleared, 40,000. Customer directly deposited amount in bank, 30,000. Bank directly credited interest rupees 2,000. Bank directly charged rupees 500 towards bank charges. Let's see one by one. The first one, bank balance as per cash book. So we are starting here as per this example. We are starting with the cash book balance. So the bank balance as per cash book or a bank book is 25,000. So that is my first line here, bank balance as per cash book 25,000. Then we need to add check issued but not presented, credited by bank but not recorded, 30,000. Credited by bank but not recorded, interest charges 2,000. When I add all these three, 1, 2, 3, 52,000 comes. This is a number value. Add 52 to 25,000, so that we get total balance of 77,000. And out of this, we need to deduct check deposited but not credited by bank, 40,000. Bank charges not recorded in the cash book, 500. So we are deducting 40,500, and then we get balance as per passbook and bank statement. Okay. See, in the template also we say whatever check issued but not presented, we need to add it. Whatever check issued or whatever directly credited by bank should be recorded. See, this is a option of doing with a favorable balance. What all we are adding, the most important thing is we need to note what all the transaction types we are adding and what are the transaction types we are deducting. Okay, so we are adding these two, check issued but not presented, we are credited by bank and directly credited by bank but not recorded in our books of account. These three transactions we are adding and we are deducting these two transactions. So we got a revised balance. Okay, now we will talk about starting a passbook with a passbook balance or a bank statement balance with a favorable balance. The template, it is just reverse what we have seen in the earlier. bank balance as per passbook I am taking it. Whatever we deducted in the earlier case, that we are adding it back. Check deposited but not credited by bank. Bank charges not recorded. These two things we deducted in the earlier template, now we are adding it back. The same way we are deducting whatever we added in the earlier option, we are deducting it. Very simple. My suggestion here is you should remember starting with cash book how we are doing a reconciliation. In an exam, if they ask start from a passbook, then just whatever we have added, you make it as a less, and whatever we deducted, we have make it as an addition. Okay, so those two things will interchange, and then we get a revised balance. Let's see example for this. The same example, whatever we have seen in the earlier case, where we started with a 25,000 as a balance. Now we have to start with bank balance as per passbook 36,500. So bank balance as per passbook 36,500. Which one we are adding it? Check deposited but not credited by bank. Check deposited to bank but not cleared. This is the one which we are adding it, and also bank charges not recorded. This is the bank charges which are not recorded. We have added it, and we are deducting check issued but not presented 20,000, this one, and then customer directly deposited bank this 30,000 and this 2,000. So balance is 25,000. See, why we are doing adding and deducting? I told a good way of doing it with knowing these three transaction types will be always be deducted and this will be added if the passbook we are starting with passbook. It is very simple. There is a bank balance as per passbook 36,500. Okay. Check deposited but not credited by bank. Why are we adding this here? Why are we not deducting it? Very simple reason. This transaction is already recorded in a cash book. Whenever we say check deposited, remember the process what we discussed. First, when we receive a check from a customer, we record in the books of account. It means we will update a cash book and then deposit into a bank. Bank will send it for a clearing, and then after clearing they record it. Correct? This particular transaction is already recorded in a cash book, but it is not recorded in a passbook. If this transaction is recorded, what will happen? It is a receipt, deposit, right? So 36,500 will become plus 40,000, 76,500. Correct? The same way, bank charges not recorded in the cash book. Why we are adding it again, this one? Bank charges which are not recorded in the cash book. See, this is a charge. Assume bank balance was 36,000 nowadays, right? 37,000. In this, we have already deducted bank is already deducted 500 rupees. So balance is coming as 36,500. But this particular transaction is not recorded in cash book. So this transaction is not recorded in cash book, so then it should not also show the balance in passbook. So that's why we are deducting this 500. We are adding back this 500. Sorry, that's why we are adding back this 500 here to take the balance back to 37,000. What we are doing, whatever the transactions were there in cash book, its impact we are adding it. Whatever the cash transactions which are there in passbook, that impact we are nullifying it. The same way check issued but not presented. Again, this transaction is already recorded in cash book and cash book balance is brought down. Right? There was a check balance of 45,000 in a cash book, and when we issue a check of 20,000, that will come down to 25,000. So this is already recorded, check issued. It is already recorded in a cash book, but it is not recorded in passbook. What is its impact? Whenever check is issued, amount will be reduced. So we are reducing it from a passbook. Same way, amount is recorded in a bank, but not uh, in bank account, but not in us. So all these things we are deducting it. So simple step is you identify, we have only around 7 to 8 kind of transaction types, which one to be added, which one to be deducted, and then proceed. The next option, next type is like we are starting with a cash book now for unfavorable balance. The template here is bank balance as per cash book. I'm taking it in a minus. Check issued but not same thing whatever we had earlier template, transaction credited by bank not recorded, and then the only difference now is we have a minus balance here and here it is add, we are saying plus. So minus into plus, again it is a, we have to deduct it, and whichever the symbol is highest, that if it is a minus, so again it will come back minus. Then we have to deduct it. So here the symbol is less. If it is a less and less, then it will become a plus. So it is a basic mathematical operations which I am explaining you guys here. If it is minus here and plus here, so minus and plus, we have to deduct it, and whatever the highest number here, that we have to put it here. If it is a minus, here it is a minus is a bigger, so I have kept it minus. And then we have a less, the amount of these two. So the less I am doing it, minus and minus, it is a plus. So the balance will come here. That will also have a minus balance. Little tricky here. The template is as same as what we have seen for a cash balance. But only thing is, you have to be careful with minus and plus balances, which is an arithmetic, arithmetic calculation, which you all are aware of it. The example for the same thing here, we are starting with cash book balance as minus 25,000 and passbook is this. So I am starting this with a cash book balance minus 25,000, adding check issued but not presented, credited by bank but not recorded customer deposit, credited by bank but not recorded interest. So the very important point, we have sum all these things 52,000. So this is a plus mark here, and this one is a minus. Minus into plus, when in additions, we have to do it deduction here. So 27,000. I'm taking which is the highest balance here, 52 or 25. The 52 is highest balance, so this is plus 27. And then what we have, less check deposited but not credited by bank. Bank charges not recorded in the cash book. These two things we are deducting it. So here balance is plus and here balance is minus. So again plus and minus, we have to make a deduction here. So 40,500 minus 27,500, it is 13,500. The highest number here is 40,500. It is negative, so I am putting it as negative here. 13,500 minus 13,500. This is how we do unfavorable bank statement reconciliation. Be careful about this negative or a positive symbol and do arithmetic exercise for the same. The rest template will remain same. Unfavorable balance, again as I said, it remains the same template of passbook, starting with the passbook, but the only thing is we should be careful about this sign. Example, we have whatever we discussed in the earlier case. Bank balance as per passbook is minus 13,500. Add check deposited but not credited by bank. Bank charges not recorded in the cash book. Minus here plus here. Though we are adding means we have to do it. The minus between these two, 27,000, and the highest numbers sign is positive, so it is positive 27,500. Check issued but not presented, credited by bank but not recorded, credited by bank but not recorded interest. All these things I am doing it. It is 52,000 here, and we are deducting, so the symbol is minus here. Again plus and minus, so we have to do a deduction. So balance as per passbook is 25,000, and the sign for bigger number is 52 minus here. So I am putting it minus here. So this is minus 25,000. The second option, what we discussed, right, the reconciliation process after adjusting the cash book balances. So far whatever we have seen, we have not adjusted the cash book or a bank book balance. We just taken the actual cash book and passbook, and then we did a reconciliation. But in actual businesses or in regular business operation, what we do is first we will record or we do all the adjustments, and then we do a bank reconciliation statement. Adjustments means what all the adjustments we do. If any transaction is recorded only in a bank statement, that we record it in bank book. If there is any errors in a bank book, that we rectify it. Then only, see, adjustment always will happen in our bank book or a cash book, but not in bank statement. But that bank statement updation should happen from bank side. So always adjustment we will carry out in our bank book or cash book. See, the words bank book or cash books are interchangeable. In sometimes they may call you as a cash book, or sometimes it is called as a bank book, but both are same. So here is an example from the following particulars on of Mr. Shankar. Prepare bank reconciliation statement as on 30th April. Bank balance as per cash book is 25,000. Okay. Now remember, I am taking a cash book balance. As I told earlier, adjustment will be done only cash book balance, not passbook balance. So cash book balance is 25,000. Let's see what all the transaction will affect are for adjustments. Check issued to supplier but not presented rupees 20,000. This will not consider it because this adjustment should happen in bank statement, not in cash book, because this we have already recorded in a cash book. Check deposited to bank but not cleared. This also we have already recorded in our cash book. It is not there in a bank book, so we will not be able to make any adjustment. Customer directly deposited amount in bank rupees 30,000. Yes, customer have directly deposited amount and we have not recorded in our cash book. So what will happen if customer deposits the amount? It will increase our cash balance. So cash book balance 25,000 plus 30,000. I'm adding it. Bank directly credited interest of rupees 2,000. Bank has credited 20,000 rupees interest. So it is again increases our cash balance. So I am adding it. So this is addition. This is addition. And the last one, bank directly charge rupees 500. It is the expenses. So this will reduce my bank balance. So it is a less transaction. We have to do a less deduction. These two are not impact. So I am adjusting it. I added these two and I got a 57,000, and then bank charges which is directly there I am deducting it to 56,500. My revised balance as per cash book is 56,500 instead of this 25,000. Once we do this adjustment, so we need not to record these transactions in now bank reconciliation statement because They have already recorded it. Only we have to take these two transactions, transaction number 2 and 3, and do a reconciliation. Okay, I'm doing it here. The last three transactions, this, we are deducting it because not needed. So balance 56,500. Check issued but not presented 20,000. I'm adding it. Both are positive, so no need to worry about this. When we have a favorable balance, it is a straightforward exercise. And then I'm deducting check deposited but not credited by bank. So the bank balance or statement is 36,500. This is how the bank reconciliation activity will be done. Okay, favorable balance of cash book implies debit balance. This we discussed many times in the previous slides. Whenever there is a debit balance, we call it as favorable balance in bank book or a cash book. When money is withdrawn from the bank dash the account of the customer. Don't think from the business perspective, you have to think from a bank side. When any amount is withdrawn from the bank, they will debit the customer account. Normally, cash book shows the dash balance and passbook shows the dash balance. Normally, cash book shows debit balance and passbook shows credit balance. This is the right answer. Why? Cash is an asset account. I'm using terms normally in case where there is no overdraft facility. In that case, normally the cash account or a bank account will show debit balance. At the same time, in the passbook it is maintained by a bank. There we will be showing credit balance because we are a liability to banker. Banker has to pay this amount to us. From the bank perspective, we are creditor or it's a liability, so it will show credit balance. Next question. Cash deposit made by the business appears on which side of the bank statement? Whenever we deposit into a bank account, we say that we are debiting bank account. At the same time, we are saying in a bank they will credit it because that amount they have to pay us, so we are creditors. So whenever we say, right, what amount is credited to your bank account, so that's what. So it is the right answer is credit. Thank you. Please share your feedback to parvamedia@gmail.com. Your feedback is valuable